go back and look at your syllabus. It actually basically lists out 10 tasks. Everything's listed there. So essentially, it's everything I've done on Disney you're going to be doing in your company through the dividend analysis. I'm going to leave the valuation, which is the very last part of today's class, as an optional part anyway, because I don't think it's fair to ask you to value a company given that we haven't spent much time on valuation. But trust me, I'm going to harass you for the next 3 weeks. So you're going to get a sequence of emails. The problem with you guys is I can't email you directly. There's this Triumph front I have to email you through. So I will send the email to the Triumph office. They will redirect it to you. So don't worry, you'll be hearing from me every week for the next 3 weeks or 4 weeks. And then you're on your own, right? So let's pick up where we left. In fact, I want to do one little tangent before I go on. Tomorrow morning when I wake up, I'm sure, and I look out of the window, I know what I'm going to see. I'm going to see I'm not in California anymore. And I haven't been in California for a long time, actually, but no. There'll be snow outside. And about 2 years ago. Now, in fact, if you're an adult, you look outside the window and you see snow. What's your first reaction? No, you got to shovel the damn thing. I mean, this is the problem with living in the suburbs. So when you see snow, you think shovels. If you're a kid, small kid, you wake up, you look out of the window, and you see snow. What do you see? You see snowmen. Right? So about 2 years ago, I was doing this. I was actually out there shoveling, and all the adults are out shoveling. They're all in a terrible mood. All the kids are jumping around. This is great. And I thought, this is exactly what separates growth investors from value investors. Value investors see shovels. When they see snow, they see shovels. So if you're a value investor, oh my God, growth investors see snowmen. The problem is if everybody is like those kids building snowmen and the snow doesn't get shoveled, we're in big trouble. And if everybody just sees shovels and nobody's building snowmen, we're in big trouble. So if you think about markets, you need balance. You need balance between those hardcore value investors. This is all about the numbers. You got to see earnings. And you need those growth investors who are, in a sense, a little out of their minds, over-optimistic, because that's essentially what keeps markets healthy. So keep that in mind, because the value investors are out in full force right now. You know why? This is their moment of glory. I told you so, I told you so, this was coming, I've been right all this time. You're going to hear these guys on CNBC, you're going to hear them in the Wall Street Journal. This is exactly why we shouldn't let these crazy people price stocks. Bubbles. You heard a lot of talk about bubbles and how bad they are. I think bubbles are good. It's a strange thing to say. What causes a bubble? Over-optimism, right? Thinking you can do things you cannot do. I ask people to make a choice. If you think about markets, the nature of markets is you will have bubbles. This isn't a bug, this is a feature. So ask them, would you rather be in a market where there are bubbles, where people are trying and overreaching and failing, or would you rather have a market which is run by actuaries? Think about that. If we lived in a world of actuaries, we'd still be in caves. Because it's a probability of this fire thing working. No, I don't think so. Let's not try it yet. So the next time as you read about this stuff about bubbles and bubbles bursting and irrational investors, step back from the process and think about why we have these. This is the nature of markets. And it's in fact what makes markets change economies. So with that in the background, let me finish the very last piece of that investment principle. We talked about measuring returns and how those returns have to be greater than the minimum acceptable hurdle rate. I did say that all side effects have to be built into returns, right? So if you want to talk about synergy or strategic considerations or whatever, my job is to bring them into the numbers. If nothing else, what I hope you have now are those tools to push people who come up with qualitative factors to make them quantitative. Don't say synergy doesn't apply. That doesn't make sense. So if InBev and SAB Miller are going to come together in their synergy, your job is to ask where. Is it in cost cutting? Is it in the fact that you can sell Bud Light in Johannesburg and Miller Lite in Sao Paulo? Where is that synergy coming from? Because your job is to bring it into the numbers. Because if it doesn't come into the numbers, this entire process is going to be wasted. You know what? Let's say you're crying through the cash flows. You come up with a negative net present value. What did we say yesterday? If you have a negative net present value, don't take the project. And then this guy at the table said, but there are strategic considerations. This conversation is getting out of control right away. Because the minute that comes up, what's he saying? Well, in spite of the negative net present value, I want to take the project. And you know what? He might have at the core a very good strategic consideration. Your job then is to extract what that is and put that into the numbers. I'll give you one final kind of anecdote to bring this home. That guy went to work at the Gap who had this conversation with about hurdle rates. About 3 years after I had that conversation, the Gap opened a new store on 34th Street. It was half a block wide. Huge store. And I was a little puzzled because remember the hurdle rate that I gave you the Gap was like 18%. There is no way. I know what the rent per square foot is on 34th Street. There is no way that store is making 18%. So I called the guy and said, how did he get the store to pass muster? How did he get it to make more than 18%? He said it wasn't even close. I said, what do you mean it wasn't even close? He said, well, we came up with like 7%, but we decided to take it anyway. I said, why? He said, well, we have these other considerations that we had to bring in. I said, like what? And he gave me a story that actually was not an unreasonable story. He said, this is one of the most trafficked spots in the city. People come out of the subway, and the first thing they see is the Gap store. It acts as advertising. It's like a flagship store. That's why we opened it. I said, that's good. So why didn't you show it in the numbers? He said, how do we show it in the numbers? It's a flagship store. People see that store. They go buy their clothes at a suburban Gap. We can't measure that. And I said, you didn't have to. Because you told me why you opened the store. It's because you think you get advertising benefits from it. So how do you bring it into the numbers?
You see the sales going up in all the places.
Well, that's going to be tough to do because you'd have to ask each person who buys stuff at your store. Are you buying because you saw the 34th Street store, right? But remember, there are lots of other factors that are going to cause it. There's a much more direct way to do it. It's an advertising. So go to your advertising agency. Presumably they're pretty, savvy about, impact of different things, and ask them how many billboards you'd have to buy on 34th Street to have the same visual impact. They say $2 million. What's the next step? Take the $2 million, show it as revenues on the store, because in a sense you're getting that benefit, and that'll of course push the return from 7% up, but let's say it pushes it up only to 12%, your hurdle rate is 18%. Then what should you do? Don't open the store, buy 5 billboards. In other words, we have to make sure that good intentions don't drive you to make bad investments. So I'm not contesting the fact that there's advertising, but my job is to be the skunk at the party. So when you come up with reasons, is to push that number through and say, hey, in spite of the numbers, this doesn't fly. Yes?
For example, how do you account for, because if the Gap doesn't allocate in that particular location, then what if this competition comes in?
Right. That's a different problem, because in a sense, this store, so you're asking about, I'll give you an even more difficult problem. There's a Gap on 57th Street. When you open a Gap on 34th Street, do some of your sales come from people who might have gone to the 57th? This is a classic problem that you face in retailing. You imagine making a decision on a Starbucks store? In fact, when you get out, when you get out of the building today, put in your Yelp, Starbucks, and you will get 6 Starbucks within 6 blocks of you. I'll wager that when you open a Starbucks store, a third of your revenues come from other stores. It's a cannibalization effect. And that's when you have to ask the question, would that happen anyway? You know when the answer to that is going to be yes? If you have very few barriers to entry, if people just want a cappuccino, even the hot dog stand guy now has a cappuccino maker probably in there. If all you want is a cappuccino, you're going to go where it's convenient, and therefore the Starbucks defense will be, we have to do this because if we didn't do this, Au Bon Pain, one of the other chains, will come and take our sales away. But it forces you then to think about when cannibalization will affect your sales and when you should show it. But that's the kind of pushback you want to make sure you put in, because if you don't ask those questions, you're going to be opening all these stores you shouldn't be opening, which is what happened to Starbucks in 2007 and 2008. And then they had to pull back in 2009 because they said, oh my God, we shouldn't have opened these stores. So be willing to push back when people tell stories. Now remember what I said, no matter how qualitative your story is, there is a number that you can move to reflect that story. View that as a challenge. Brand name, show it in the numbers. Great management, show it in the numbers. Corporate culture, show it in the numbers. Okay. So it took us a while to do this as well, but the return should reflect the magnitude of the cash flows. When you get the cash flows, and have all side effects built in. So that's the investment principle. Let's now turn to the financing principle. I'll tell you the biggest problem with talking about debt is inside each of us is this sense that debt is a bad thing. Weak people borrow money. You know where that comes from? Every religion in the world, without bar. In fact, that's why it comes, because in a sense, every religion in the world, no matter what it is, views debt. In fact, the people who borrow money are viewed as weak. The people who lend money are viewed as worse, as wicked. Wicked and weak. And this is hundreds of years. You're fighting centuries of this built-in lesson. And there might be a seed of truth to it, but that's one of the barriers you're overcoming. So I often talk to CFOs about borrowing money, and you might think you're talking about financial stuff, but this guy's listening to his last church or temple or sermon and say, oh my God, the priest said, don't borrow money, don't borrow money, don't borrow money. Now this guy's coming and talking about cost of capital. You think you can beat a religious view with finance? It's not going to happen. So sometimes you just have to realize where people's opposition to borrowing money comes from, and you got to let it go. That's the way it is. The only problem is that this is your own business and you feel that borrowing money is sinful and you don't borrow money. It's your choice to make. So if you're a private business person, I will not borrow money, I feel uncomfortable. Good. But if you're a CFO and you give this, you know what I'm going to tell you? You're feeling uncomfortable, take some Xanax. Now go borrow the money. Because in a sense, it's not your company anymore. You can't say, I don't like borrowing money, therefore I don't borrow money. So what I want to set up here is this trade-off. Why we borrow money. And let's face it, it is the tax code that pushes you to borrow money. John? You have the question? So essentially, I'm going to start off with that question. What's the right mix of debt and equity by looking at the trade-off? What are the pluses of debt? What are the minuses? And try to keep as open a mind as you can as we go through.
It is not only the tax, it's also, you cannot...
It is only the tax.
But how will you grow if...
In fact, you can answer the question. What are the two ways you can raise money? Why aren't you raising equity?
In some industries...
No. Let's. Why isn't Khanna paper raising equity if they want to grow? Because you'll have to sell equity to somebody who's not a Khanna. And he says, I don't want that. So if you don't raise equity, be very clear about why you don't raise equity, which is you want to run this company as your company. So for you to grow, you have to borrow money. But we forget the choices we made. You made a choice to stay a family-owned company. And I'm not going to contest the choice.
Cost of both.
But that from a cost perspective, if I take the tax benefit out, you should never borrow money. In fact, we'll see why. Because debt can only bring bad things to this game if you have a choice and you don't have the tax benefit. So let's look at that trade-off. Before I do that, let me show you what my companies look like in terms of the debt they've taken on. So here are my 4 companies. There's the book value of debt that came from the balance sheet. Remember how I estimated the market value of debt by looking at it as a bond, so I did that. I did convert the leases to debt. Notice that Disney, Vale, and Baidu have significant lease commitments. Tata Motors does not, but that's actually a lie. Tata Motors doesn't seem to break down its lease commitments, so I couldn't find any. They might, right? Then I broke down what type of debt they had. Disney, 92% of the debt is bonds. In fact, Patricia took me to task for using the word bonds and debt interchangeably, right? And I've used the two interchangeably, but you can see the way they borrow money is very different. Disney, like many US companies, larger US companies, tends to issue bonds. But as you go across, you notice that, that the proportion of bank debt is higher for bonds. I have to tell you, 20 years ago, if you looked at Vale and Tata Motors, 100% of their debt was bank debt. Even in emerging markets, you're starting to see the shift from bank debt to corporate bonds. Is one better than the other? Depends, right? Sometimes if the bank knows you really well, the bank debt might be cheaper. Sometimes if you feel markets can spread the risk out. So there is no obvious plus or minus to one or the other. It is true that bonds open the game up, because if you don't have the option of issuing bonds, you are at the mercy of the bank, right? In many emerging markets where you don't have the capacity to issue bonds, you could have banks. Remember that synthetic rating we came up with in a spread? You work that number out, you come up with 5% for your company, you go to the bank. The bank says 9%. What are you going to do? You're going to go to another bank. It's like collusion. 9, 9.25, 8 3/4. It's all set. So it is good to have that second option, because at least you can say, hey, you're charging me too much, I'm going to go raise the money elsewhere. In terms of maturity, if you look at Disney's debt, about 49% of its debt is 1 to 5 years. If you look at Tata Motors, about 58% of its debt is 5 to 10 years. But if you look at Vale, they have much more long-term debt. For the moment, file that away, because one of the questions we're going to come back and ask is, why do some companies borrow short-term and others long-term? What causes you to borrow short-term or long-term? In terms of what currency the debt is in, 94.5% of Disney's debt is in US dollars. 5.5% is in foreign currencies. Now again, one of the questions we're going to ask is that the right mix? And guess what we're going to look at? It's very simple again. What are we going to look at to make that judgment? Remember I broke down Disney's revenues, and 82% came from the US and 18% came from outside. Already you can see a disconnect. Maybe they have a really good reason for doing what they're doing, but that's going to be one of the things we're going to push back on. How come when 18% of your operations deliver cash flows in other currencies, you're only 5.5% in debt? When I look at Vale, 35% of the debt is in reais, 65% is in foreign currency. And again, you can start thinking about, where does Vale get its revenues? And maybe we can start opening the doors. Why does Vale use so much foreign currency debt? Tata Motors, 71% of its debt is in foreign currency. I'm sorry, is in domestic, is in rupees. 29% is foreign currency. And here there's a seed of a problem coming. You see why? Because Jaguar Land Rover each year gets bigger and bigger. In fact, right now, Jaguar Land Rover is roughly the same value as Tata Motors within the company. But they still don't have as much debt as that value reflects. And then we get to Baidu, and this is a problem. Yes, go ahead, Patricia.
No.
Yeah. And so let me finish the Baidu story.
Yeah.
If you look at Baidu, 18% of their debt is in renminbi, 82% of their debt is in US dollars. Do we have a problem here?
Yes.
Yep.
And this is a problem that you see in lots of Chinese companies, and that's why this crisis is going to have legs. Right? Because if the yuan renminbi gets devalued and you've mismatched, you borrowed in dollars to fund, you are going to get squeezed. And it's not, Baidu is not borrowed enough for this to be an issue. But if you look across Chinese companies, especially the Chinese infrastructure companies, not only have they borrowed money in US dollars, and now I think the chickens are going to come home to roost. That's a nice term, right? Baby out with the bathwater, chickens come home to roost. Because in a sense, you mismatched. Yes, Patricio, now.
Yeah, sorry. I wanted to understand your view about the difference between the debt.
Right.
So,
on what dimension?
In terms of bonds, other debt, and bank loans.
Okay.
Because I have some numbers in front of me. In
Right.
the US, seems that 41% is bonds,
Right.
issue notes, 26% is bank loans, and 32% is other debt. In Europe, just 11% is bond, 45% is bank loans, and 44% other
Right.
debt instruments. So, the European Central Bank said that European companies needs to have much more bonds, needs to go
Right.
in capital markets. So
Right.
they they seem to have a different view that you have. Because if I understand your view, probably I'm wrong, you said it's debt. But if I...
No, I also said that it's always good to have that corporate bond option available. If you choose to use bank, so if Disney borrows from a bank, I'm not going to say it's suboptimal. So
from the corporate perspective,
right.
What do you think? That should be much more balanced, like is in US, or it's the same? Basically?
It depends on two things. First is it depends on how deep and how liquid the corporate bond market is, right? And that's the problem Europe did not have. 20 years ago, the European corporate bond market was dead in the water, right? In fact, when Telecom Italia did its acquisition of, when Telecom Italia was acquired in a hostile acquisition in '98, they had a really tough time making a corporate bond issue.
It was a leveraged buyout.
Yeah. So basically, what a corporate bond market allows you to do is not only does it free corporations to borrow in a different way, but remember we talked about activist investors, people who can push a company to change. How does a Carl Icahn or a Bill Ackman come up with the capital to go out and do an acquisition? They start with their own capital, but if you're buying a $100 billion company or a $150 billion company, you got to borrow money, right? Now let's say I want to do a hostile acquisition of Telecom Italia, and the only people I can borrow from are Italian banks. What do you think is going to happen when I approach an Italian bank and say, I'd like to do a hostile acquisition of Fiat. Let's make it a real, a price company. I'd like to do a hostile acquisition of Fiat, and I'd like you to lend me money. The banker is going to say, I'll get back to you. He's going to go into his office and say, Mr. Agnelli, somebody's out here saying he wants to do a hostile acquisition of your company. Should I lend him the money? I mean, there's this mythology, at least in Italy. Maybe I have this wrong perception that for a long time, 6 people got together in a room and decided what would happen for the next year. So the other thing corporate bond markets then allow you to do is say, if you don't like the way a company is being run, it gives, because corporate bond markets basically also open it up to other people to come in and borrow money. So I think it is good to have a deep and liquid corporate bond market, but it's almost chicken and the egg, right? When you first issue corporate bonds, it is going to go into a market that's not deep and not liquid. And sometimes you're going to get burnt because of it. But you got to start somewhere and you got to push the process too. And if you look at the 11% for European companies, 25 years ago, that was probably 2%. So the trend lines are all clear. You see corporate bonds growing. And it's amazing, they're growing faster in emerging markets than they are in Europe. What? Indian companies are more, in fact, Indian companies issue more corporate bonds as a percentage than European companies have, partly because many of them are issuing bonds in a foreign currency and then using these hedging mechanisms to kind of get it back into rupees. So they're finding their own ways outside these markets to raise money, and I think that's healthy when it happens. One final point, I looked at how much of the debt was fixed rate and how much is floating rate. Somebody explain to me what the difference is. Fixed rate debt, what do? You go to, basically, it's not the same amount. Contractually, you set it up front and you're stuck with that rate. Most bank loans are fixed rate. Depending on the country. Most bank loans in the US are fixed rate. Let me take that back. In countries where inflation is, bank loans become floating rates. Right?
No, most bank loans are floating.
Even in corporate bank?
All the bonds are fixed, so the bank loans are floating.
Okay, because all of Disney's bank loans were fixed rate loans. So I don't know whether that's a subset of the market. Okay.
India, all loans are also
all floating rate. So basically the fixed rate, floating rate choice then becomes a function of both what the lenders are willing to give you and what you'd like to pay. So one of the questions we're going to address today is, hey, how do you make a decision? If you could make the choice as a company, would you prefer fixed or floating rate? And the answer again varies depending on the company. I mean, it's not obvious that as a company I want fixed rate loans. You think, but I do. Today's rates are low. But what if rates are high? What if rates are volatile? So this is just a picture of where the company is. So let's look at the trade-off. Pluses and minuses of debt. If I'm missing something, bring it into the picture. Debt has 2 pluses. Big advantages. The biggest by far is what we've talked about so far. Debt has a tax advantage. What's the tax advantage? Interest is tax deductible. And the implication is very simple. The higher the marginal tax rate, of the country you operate in, the greater the benefit to borrow money. So it's a no-brainer. I would expect a company with all U.S. income to borrow more than a company with all Irish income. It's the nature of the process. So that's the first. The second benefit is a little more subtle. There are some companies, where by borrowing money I can force the managers to be more disciplined. This is kind of a perverse argument. And here's the argument. Remember we talked about corporate governance? That in some companies managers just do whatever is in their best interest. Let me ask you a question. If you're the manager of a company, which of the two options I'm going to describe is going to give you a more comfortable life? You're managing a mature company, lots of cash flows, and you never borrow money. Or you manage a mature company, lots of cash flows, and you borrow money. Which of those two scenarios is an easier one for you? If you don't borrow money, then you don't have that weight over your shoulder as a manager. You don't have to worry. So, as a manager, if I left you to your own devices, you have this cushioned life, right? Cushioned by cash flows, cushioned by the fact that you have no debt, and then you start to get to do sloppy things. Like what? You take a bad project. Who's going to notice? You make $5 billion in cash flows, you have a $100 million loss, hey, you just write it off. So here's what I'm going to do, and this is why it's perverse. I'm going to force you to borrow money. Why does that make you more disciplined? Because now you have to make interest payments on the debt, and now if you're sloppy and take bad projects, what could happen? You could go bankrupt, but let's make it personal. After you go bankrupt, you lose your job. So it's about, I'm trying to inflict pain on you. By saying, if you make a mistake, I want you to feel the pain, not just me, because you're playing with my money. So up till now, I've been the one feeling the pain. Now, welcome to the club. This is called the Jensen free cash flow argument for debt. Yeah.
Yeah, but if I have a plenty of cash and I lend it to the bank, let's say, I received the loan.
You're lending it to the bank?
Okay, there is a cash. Yeah, where is the cash? So it's my current account. Yeah, anyway, I received.
But I've never heard of a corporation lending to a bank. I mean, it's basically.
So if I have a free cash,
you invest in securities, basically, right? So basically, you buy bonds in other companies or T-bills or commercial paper.
Interest payments which I receive when I borrow, when I take money, will be higher than when I receive. On my.
You can't run a financial service company with this is how companies get into trouble. In Brazil, for instance, in the early 90s, every company started running a financial service arm on the side. Aracruz made more money from its financial service arm by doing this, right? If I want you to run a bank, then I'll just invest in a bank, right? So if you have a lot of cash, all I'm saying is you have the luxury of making mistakes and getting away with it because you have a buffer against your mistakes. So you can do whatever you want with the cash, but that doesn't take away from the fact that you have lots of protection against mistakes, and I'm just trying to remove that protection a little bit, right? Yeah.
But there can be companies like who have so much cash that they want to just create an asset and make loss for next 20 years.
What kind of mindset would want to do that? No? So basically, why would you want to create an asset that has a loss? Is this a tax thing talking, or is it?
A company in India which is having a lot of tobacco money.
Right.
So they are investing
then that's exactly the kind of company I want to stop doing what they're doing, right? Because if you're a tobacco company, you're making a lot of money, and you wasted on something. You know what I'm going to like you to do? I'm going to like you to go borrow money against the tobacco money. That will force you to make the interest payments. I'll get whatever's left over. You won't make the stupid. So in fact, you're making my case even stronger. That's exactly the kind of company I want to borrow money.
Why would they do that?
Why don't they do it?
What is the motive?
What is the motive for doing it? It's other people's money.
No, also they say that next 20-30 years tobacco will probably die.
Yeah.
So we need to create other things.
So there's that corporate sustainability thing, the crap that we get fed. Companies have to survive. I have to become an energy company as a tobacco company. Why? A food company if I'm a tobacco company. So there are all kinds of perverse things that drive this. I don't want you to do that. So I'm going to make you borrow money, give the cash back, shrink your business. In fact, just as a side note, I'll come back to it about IBM. There's a story about shrinking and learning to live within your means, where I think IBM is actually kind of a good way to describe what happens when a company recognizes that the world is shrinking around them and behaves appropriately. I think IBM's got a lot of abuse for what they've done. Over the last decade, IBM's returned 130% of its earnings as cash flows, as dividends and buybacks, collectively. It is, I think, the third largest returner of cash in the US over the last decade. So I read this news story in the New York Times. Our journalist says, this is awful. IBM should be investing this money. They should be growing. The question is where? I mean, and I think IBM has done, I think, what's sensible given the opportunities they have, which is the business services arena, which is where IBM makes most of its money, is getting more intense, more competitive, and you throw money into it, you could get growth, but it's not going to be value-creating growth. So we'll talk about narratives and valuations, and the IBM narrative is actually a fascinating one in terms of a company living, acting its age. Saying, you know what, our best days are behind us. They will never say that out loud, but they've acted on that.
IBM is actually trying to pivot around things and then getting rid
That's serious. So the end game is, let's get this and let's go back to a slimmer, more profitable stuff. But each year I watch them, they're getting almost anorexic at this stage, right? So basically, so that's the question: is where does that process play out? Yeah.
It's a wonderfully practical thing to do, but isn't that also an indication that management has almost given up on where to take the company next?
Okay. Here's the thing, though. You're right. It is also, but remember that managers also have to realize that they can't control outcomes. So if you're in a bad business, you could be the best manager in the auto business, but you're in a bad business. You're in a bad business. And I think that's the problem I have with the lesson that gets sent out. If you're a great manager, you will have a great money-making company. Hey, that's not necessarily true. You're in the wrong country, in the wrong business. You could be Steve Jobs reincarnated, and you would still have a problem. So two big pluses, right? Interest benefit and this added discipline. Yes?
Isn't there one more thing? If you allow for stock markets to be not efficient,
Right.
so if you consider your stock to be underpriced, that's kind of the problem.
We'll come back to that. That's actually a different problem. So then it's not even a benefit of debt. You're saying the stock is underpriced. I'm going to buy back. You could do it with cash. It could be debt. So that's almost another way of kind of taking advantage of market mistakes.
Yeah, if you issue equity in that situation, you dilute
Yeah.
your equity.
So there's a timing issue too, which is when you issue equity. So let's put that in the background because that's almost a market-related issue, a timing issue. Yeah.
How about the solvency discussions? Some managers, for instance, in financial services, they're proud of themselves saying, oh, we have this.
We're talking. That's the other side. That's the advantage. That's a disadvantage of debt. So when people say they push back against debt, here are the three costs. The first is the solvency bankruptcy issue, which is when you borrow money, whether you like it or not, you've exposed your risk. Not only do you have to pay the interest expense, that I can live with, but you've exposed your risk to problems, default, survival, somebody else taking over the company. And that expected bankruptcy cost has two components to it. The first is the probability that you will go bankrupt, which every time you borrow money, no matter who you are as a company, will increase. You're saying, what if I'm ExxonMobil? Even ExxonMobil, if it borrows another $50 billion, will be more exposed to default risk than it was before. It still might be tiny, but it's still there. So that's the probability of default. The second is the cost of bankruptcy. I'm going to ask you a crazy question, but humor me. What's the cost of going bankrupt? You're saying stock price goes to zero. That's already happened. By the time you actually declare bankruptcy, the slide has already occurred. It's not like you go bankrupt with the stock at 100. You go bankrupt with stock at 10 cents. So what happens when you go bankrupt, actually? You end up in the court system. Incredibly efficient process, right? I still remember when I became a citizen of the United States in the mid-90s. About 6 weeks after I became a U.S. citizen, I got a letter in the mail from the local courthouse inviting me to partake in my citizenly duties. So, of course, an invitation to jury duty. And to show you how naive I was actually excited about the prospect. So I circled the date in my calendar 6 months out. This is good. So the day it comes, I dress up nicely, which is as nicely as I can get dressed up. I will carry the letter with me and I walk in expecting balloons and celebration, and there's a bored-looking woman behind the table. So what are you here for? It's jury duty. So go sit in that chair. Do what? What's the terminal? What am I watching for? Your number. Where is it? She shows me a number. So what if it doesn't come up? Come back again tomorrow. I said, I can't keep coming back every day. She said, don't worry, we pay $10 a day. I said, okay, I'll come back for the rest of my life. This makes it an easy choice. But that kind of cuts to the core of how the court system views your time and my time and everybody's time but Patricio's time. Or, In other words, everybody's time except the lawyers, everybody's time. What does it matter if your case takes 6 years? You have nothing else better to do with your life anyway, right? That's the system you will end up. There was a study in the 1970s that looked at railroads in the U.S. that went bankrupt. Pretty much every U.S. railroad went bankrupt. That's how you created Amtrak, is from these bankrupt railroads. And it looked at how long it took between the time the railroad declared bankruptcy and you actually got paid as somebody owed money on the bankruptcy. 7 years. Very biblical. 7 years it took between the time you declared bankruptcy. And 50% of the assets of the railroads went to cover legal costs. My son works at this outfit called Duff & Phelps. It's an appraisal firm. It's a global appraisal firm. You know what he's been doing for the last 6 weeks? Working on the Lehman case. The Lehman case. I've almost forgotten that there was a company called Lehman. It was that long ago. This, of course, was what? 2008. Now we're in 2016. They're still working on the Lehman case 8 years after. And I remember reading a couple of years ago that the legal fees in the Lehman case had crossed $2 billion. $2 billion. That was 2 years ago and they're still going. By the time this is all done, if you were owed money on the Lehman case, you're not getting it. That's where you're going to, that's called the direct, the deadweight cost of bankruptcy. But there's a more, yeah, go ahead.
He's in food.
You don't have to defend the Lehman.
I want to say that, other consultants get more fees.
That's true. It's not the lawyers alone. It's everything with the bankruptcy process. The bankruptcy consultants, bankruptcy,
I want to understand better your statement. Because you are, what you say, it's very, very important for us. So all of us, we take notes about your words, what you say. So you said that a company with more debt has more probability to be in default. You said that, okay, literally, and I took a note.
You have a disagreement? Let's stop right there. Is that statement?
I understand that you agree, Mr. Chairman, and you. So I disagree because it depends the reason of my debt. It depends what I'm doing with
I'm not comparing across companies. Maybe you're misreading my statement. I'm not saying a company with more debt has a greater chance of going bankrupt than another company with less debt. I'm saying a company with more debt has a greater chance of going bankrupt than the same company with less debt. Do you see what I'm saying?
Same company, same assets.
Same company, same assets. So that's all I'm saying. It's a very simple statement.
Same company,
because we
same
changed,
assets.
of course. That's so So that's the direct cost. There is a second cost that is an incredibly insidious cost, which happens before you go bankrupt because people think you might go bankrupt. Yes?
Quick question.
Yeah.
I'm already bankrupt. What do I care? What's the cost of my legal?
When you say you, who's you?
The company is already bankrupt.
Company has no money. So let's be specific. The stockholders have lost their money. You're saying, what do I care? But then it's too late to care. But what you're asking is, this is before you go bankrupt. You're saying, how much should I borrow? After you go bankrupt, of course, it's over, right? But you want to make sure that you don't borrow so much that that becomes the conclusion. So this is a choice you're making when you're healthy. When oil prices are $100, things are looking good. You're saying, should I go out to borrow money? I'm putting this little niggling doubt in your head saying, hey, you can borrow money. You're Glencore. You're making a lot of money. But remember, you borrowed this money, it is going to increase your chance of going bankrupt. And at that stage, you know what you're going to tell me? I make so much money. Commodity prices are so high. China will bail me out. What does it matter? So all I'm saying is when you're healthy and you borrow money, it's easy to forget that this can happen, right? And I'm saying, you have to think about it. Yeah.
Management would also take in consideration the risks that they own in their own patrimony if the company goes bankrupt.
Well, I think managers have their own incentive structure that might lead them to borrow more or less, but this is something you have to factor when you borrow money. Yes, sir.
But normally, isn't it that the less you borrow, then you are risking bankruptcy. The more you borrow, then you are too big to pay.
You have these very perverse things that you. How can borrowing less actually make you? Are you talking about too big to fail kind of thing? Too big to fail has nothing to do with this, right? This is basically if you're a $500 billion company, then the government has, so if you're talking about really large companies, we'll come back and talk about that, how that plays out in your debt decision if somebody else bears the cost of bankruptcy. Because that's what you do, is you socialize the cost of bankruptcy. Governments face it, taxpayers do. That's a different problem. But let me talk about the indirect cost of bankruptcy. Here's what the indirect cost of bankruptcy is. If people think you're in trouble as a company, are you in trouble? Let's go group by group. Your customers think you're in trouble. What starts to happen? They might not buy your product because, so especially if it's a long-term product. So if you sell appliances, or worse, if you sell aircraft, and I think you're in trouble, I'm stepping back saying, I'm not buying your aircraft. No, you have a 20-year life. Where do I come for spare parts if you're gone? So that's, your suppliers start behaving differently when they know you're in trouble?
Yep.
Yeah.
What do they demand?
They charge premium.
Forget a premium. They say, give me cash. Give me cash up front. Forget about the 60-day pay. So your suppliers start demanding cash. Do your employees start behaving differently because you're in trouble? They start checking out monster.com while they're sitting and they're saying, maybe I won't have a job in 4 weeks. The perception of being in trouble will actually put you into this debt spiral, and you want to stay away as far as you can from that link. And that's the other thing that's tough to remember when things are going well, is you go out and borrow money, so what can happen? And the next thing you know, you hit a tipping point, and all of a sudden you start to see things spiral out of your control. That's an indirect bankruptcy cost. So when you go out to borrow money, you've got to factor in both how exposed are you to the probability of bankruptcy and what the cost is. And remember, that cost, the indirect cost, is going to vary across companies. If you're an aircraft manufacturer like Boeing, you've got to be really scared about that happening. A BB rated Boeing is dead in the water. So you want to stay as far away as you can from that possibility. If you're a grocery store, I don't know about you, but I don't walk into a grocery store and say, this is a AAA rated grocery store or a BBB rated grocery store. I don't care. It's not like I plan to bring the lettuce back next week or next, 2 years from now. So if you're a grocery store, you can afford to let your rating drop and get away with it. So what? If I'm going to do a leveraged buy, one of the first things I do when I see the announcement of a leveraged buy, fewer of them now than there used to be, is I look at who's being targeted. It's very simple. Because if it's a grocery store being targeted, I cut some slack. Okay, I can see you dropping the rating and living. But if you're targeting an aircraft manufacturer, I don't care who's doing it. If you're Goldman and you KKR rolled together, it doesn't matter. It doesn't make sense. So that's a bankruptcy cost. The second cost is an agency cost. What's an agency cost? In Econ 101, we make this big deal about principal agent problems. What's an agency cost? Yeah, but let's get more specific. Anytime you ask somebody else to do something for you, notice it never gets done right. You're sitting down, a group of 5, you want a sandwich, one person offers to go pick up sandwiches, and you're very specific. You say, turkey on wheat, no mayo, lots of mustard. What does the person come back with? Ham on white, lots of mayo, no mustard, because she got to the front and said, what did he want again? Who cares? It's not my sandwich. That's a classic principal agent problem. I'll give you an even better principal agent problem. How many of you have kids? Okay. Mine are grown up now, but when they're smaller, if you have to go out, you have to hire a babysitter. Classic principal agent problem. Because to get the babysitter nailed down, 4 weeks ahead of time, you got to get a name, and you got a backup and a backup to a backup. Day arrives. It's like once every the 2 times a year that my wife and I used to go out. And you can see, I'll tell you, at the end of the story, you can see why it's going to be only 2 times. So 7 o'clock comes, the babysitter's not yet. 7:20, she wanders in. And you give her instructions, very specific ones. Small kids around the house. So feed them at 8. Send them up to bed at 9. And after 9 o'clock, no sugar.
Right.
And you leave. Go for a movie, go to dinner. 9 o'clock rolls around, the babysitter is on the couch watching Pretty Little Liars or whatever TV show she wants. The kids sense weakness. Kids are amazing. So 9 o'clock, they all come down as a group. It's like a it's like a horde of people, and they converge on the babysitter. We want ice cream and candy. And the babysitter remembers, but your parents said no sugar. So we want ice cream and candy. So the babysitter says, look, I can fight these kids for another hour and end up not watching my show. Or I can feed them ice cream and candy. They're not my problem. Says, take the sugar bowl with you upstairs. Here, take the entire carton of ice cream. Do whatever you want. I'm watching a show. 10 o'clock, you come home. You pay the babysitter. She's in a hurry to leave. You don't know why. She just takes off. And then after she leaves, you notice the kids are bouncing off the walls. It's a classic principal agent problem. And there are 2 solutions to the principal agent problem. One is called the monitoring solution. What this is, you install cameras or recording devices all over your house. You carry a portable terminal with you so you can watch your kids at all times. So at 9 o'clock, while you're sitting in the restaurant, you notice the ice cream coming out of the fridge. You have to get home right away. Maybe you install stun guns around the house and stuff to stun them right away. But that's a monitoring solution. The other is you build in the cost into the decision process. What does that mean? You go out only twice every year. You say, if I go out, I will not sleep that night. Therefore, I will not go out as often. You see, what's this got to do with debt and equity? Let's play again. You guys be the equity investors. I gave you the fund side. You guys be the bank. So you're going to go borrow from them. Ready? You traipse into the office. You say, I'd like to borrow money to take a project. Now, how are you going to describe the project? A safe project or a risky project when you go to the bank? Safe. I will look after this money like it is mine. Let's say you're a trusting banker, which is an oxymoron. And you say, you look honest. Here, have $1 billion. No strings attached. Because after all, they told you it was going to be a safe project. Now they've got your $1 billion. No strings attached. You told them it was going to be a safe project, but you're not a person of your word. Now what might you be tempted to do? You take the $1 billion to the local racetrack. You put in number 23. It loses. What do you claim? Limited liability. You can take whatever you want. Of course, there's nothing there. And if it wins, you make $25 million. You pay the bank. In fact, you might even throw a bonus interest payment. And keep the rest. This is an asymmetric game for equity. Do you see? The upside is yours. The downside is theirs. So guess what bankers do? They don't stay trusting for too long. So when you come to borrow money, even though they say the project is safe, what do you assume? You're lying. It's risky. So I'm going to charge you an 18% interest rate. Then you write in all the things they can't do. You can't do this, you can't do this. Don't even think about doing it. Have you ever seen the loan covenants for a small business that borrows money? This is like picking up War and Peace. 1,400 pages of things you can't do. Here's the way I think about debt. When you borrow money, you're putting yourself in a straitjacket. Comes with restrictions. And the more you borrow, the tighter the straitjacket becomes. Now, should you care? If you're already a regulated company in a straitjacket already, like the regulated monopolies in the US, you don't care that you're being put in a straitjacket, you're already in. But if you're a technology company, let's say, can Google afford to borrow money? Company's a cash machine. Why isn't it borrowing money? The answer might very simply be that they value their flexibility so much that the last thing they want to do is make that trek to the ratings agency and try to explain why they're producing electric cars. The more you value flexibility as a business, the less you should borrow. So the more predictable your business becomes, the easier it becomes to borrow. The less predictable it becomes, the more you should hold back. And there's a final related cost is every time you borrow money, you lose that capacity to borrow money in the future. There's a loss of flexibility. That's the trade-off. Tax benefits, added discipline, bankruptcy cost, agency cost, loss of flexibility. So let's think about how these play out with my companies. When I look at the tax benefits, the tax rate of 40% in the US is going to mean that debt is always more advantageous to Disney and Bookscape because they're US based, unless you can get US income if you're there. Yeah.
Just one question.
Yeah.
The debt is also used to leverage the company. So maybe I want a higher beta or something. Is that?
No, but remember that's going to be a wash, right? So basically, when I borrow money, you return in equity. That's what the leverage. You talk about the good side of leverage. Your return equity goes up. If all it does is leverage, it's actually very easy to show mathematically that it looks like you're creating value, but it's just running in place. So unless I put in the tax benefit, this always shocks real estate people when you actually show it. Unless you put in the tax benefit, that is not creating value. I mean, in fact, I'm going to give you the classic Miller-Modigliani theorem, and you can see where it comes from. It makes some very, very unrealistic assumptions. You're going to see that when debt creates value, destroys value, that it's got to come from something out of the process beyond just leverage. Okay? So in this case, if you look at my companies, tax benefit is greatest in Disney and Bookscape. It's slightly lower in Tata Motors. It's even lower in Baidu. And Brazil has a very strange tax system. Brazil has a lot of strange things, but this is one more strange thing. Is in addition to giving interest expenses a tax deduction, Brazil about, I don't know how many years ago, decided that it wanted to be fairer to equity. So what they allow companies to do is take their book equity. So this is going to matter because it explains a lot of things you observe in Brazilian companies. Take their book equity and multiply it by an interest on capital that is set by the government. So let's say it's 12%. And your book equity is 10 billion. You can take 12% of 10 billion and claim it as a tax deduction, which effectively means the tax benefit of debt gets smaller because it's a very ham-handed way of doing it because it creates some consequences. Because if I give you a percentage of book equity as a tax deduction, what's your incentive if you're a company with book equity? You want that number to be a high number or a low number? Brazilian companies have among the highest book equities around the world. I've seen portfolio managers often pick stocks based on price to book, and Brazilian companies keep popping up as cheap, cheap, cheap. And before they freak out, I say, look, maybe you want to check out this book equity. There might be a tax reason. In fact, in the original Embev, when Embev bought Embev, out of the $2 billion premium paid on that acquisition, $1.1 billion came from just this interest on capital. Because after an acquisition, what happens? Your book equity inflates. So it's just a pure tax benefit. Brazilian taxpayers subsidizing a Belgian brewer buying a Brazilian brewer. That's the nature of tax law. Yes?
In a few countries like where there is a MAT, you have to not pay the marginal tax but the minimum tax. So how do you take the minimum tax?
No, still you're going to claim the interest. So is that the minimum tax is just a floor, right? You can't pay below that?
It's not. No, it is that if you're investing and depreciation and all is high, you still have to claim.
That's like an effective tax rate. So there's a floor. Basically, they put an effective tax rate with a constraint. You'd still use the marginal tax rate. The benefit is still at the margin. Okay? On added discipline, remember what I said, you force managers to borrow money to make them more disciplined. You shouldn't need to do this at Tata Motors, right? Why? It's after all family money playing in there. And if you shouldn't the family shouldn't, if you're the owner of a business and the only way you can be more disciplined is by borrowing money, you're in a serious, there's some serious psychological damage going on there. So, with Disney, the benefits are highest because the separation between stockholders and managers is great. So this goes back to that corporate. The bigger the corporate governance problem you see, the more debt you're going to push on the company. Expected bankruptcy costs? Yes, go ahead.
Just kind of going back to the last point that you made. Wouldn't you take on debt if you believe that the delta between your invested returns and the debt value?
That's actually another variation of the leverage point, which is, let's suppose you're a real estate investor and you think you can make 8% on a building. If you can borrow money at less than 8% after taxes, you in effect are increasing your return on equity. That's going to be true for almost every business. Borrowing money increases your expected return on equity. But is that good or bad? What do you compare the return on equity to? The cost of equity, right? The cost of equity when you borrowed, so let's say you borrowed no money, your return on equity was 8%, let's say your cost of equity was 7. You decide to borrow money, you can inflate your return on equity to 15, 16, 17%, but what's happening to your cost of equity while you're doing that? If you do it right, and that's why I went through the process of levered betas and unlevered betas, I'm not going to give you a free lunch. I'm going to say, look, you know, you increase your return on equity. Let me tell you what your new cost of equity looks like with all the debt you took on. It's going to rise as well. You might still end up saying, this is good for me, but there's actually going to be a tipping point where that extra dollar of debt, what it does to your return on equity, is not covering what your cost of equity does. That's where you stop. And that's what most people don't seem to stop at. They're so focused on the return on equity that they've forgotten the other half of the equation. Right? Bankruptcy costs come from earnings being variable, right? It goes without saying, especially now in the commodity business. But if you're a commodity company, you move in cycles. This has been true for hundreds of years. We forget when we're in the midst of a cycle that a cycle exists. But if you're Vale, you've got to think about that cycle, that commodity cycle. If you're Tata Motors, you've got to think about economic cycles. Okay? And if you're Disney, you might be able to spread things out because you're in multiple businesses, but you have to think about the entertainment business itself changing under you. So all those things are going to contribute into how much you borrow. So if you're running Disney and you feel the entertainment business is on the verge of a shift into a new mode of making money, you might hold back on borrowing money because of the volatility that it's going to. In terms of agency costs, its highest, I mean, remember what the agency cost is. When you went to borrow money and they lent money to you, they couldn't quite see what you did with the money, right? Now, if you're a company with tangible physical assets, as a banker, do you feel more comfortable lending to them? Because you can see the asset, right? This is why people like to lend on buildings. It's physical. You can drive around the building. So that's a building. The fact that the building is completely lost value. That's a nuclear power plant that has leaked. Doesn't even cross your head. Big building, drive around, looks good. But if you have intangible assets, then you can see why bankers get really uncomfortable. You're doing R&D. That's why you borrowed money. How do I know? You claim to be doing R&D. For all I know, you're pulling people off the street, putting white coats on them, say, wander around the building, look busy. Nothing's happening inside. It's not like I know research when I see it. I mean, I'm expecting test tubes. That's all I know. Chemistry class in high school. No. So you can already see why at Baidu you're going to be uncomfortable. And why technology companies collectively, even when they're mature, will borrow less money. It's not because they don't even want to borrow more money, but because people will stop lending the money at a level much lower. And I actually think there are some businesses that borrow far more than they really should. And real estate is a classic example. People lend on real estate on bulk and physicality. And the more physicality, more bulk, and the more gold you put on the building, as Donald Trump has discovered, allows you to borrow more and more and more money. The more garish. I was just in Dubai. I mean, you look at these big buildings. I mean, I'll lend money. Look, it's a big building. Big, huge. Agency costs. Flexibility needs, it depends on how much uncertainty you see in these businesses. The more uncertainty you see, the less you should borrow. So if you think about the trade-off, even without looking at the numbers, you can see why some companies will borrow more money than others. Now let me put you into a world which is, I've made up the world. Just think of it as another made-up world with assumptions that are completely unrealistic. But think of this as a Twilight Zone episode. And here are the assumptions I'm going to make. So let's say you live in a world, so that there are no taxes. So you can make that qualitative trade. Let's say you live in a world where there are no taxes. So it could be Ireland has taxes. Cayman Islands doesn't have. Bermuda doesn't have. Yeah. I'm sorry? Well, so basically, so let's remove all tax. I don't even know where that would be. Jersey? Yeah. So no taxes. No Dubai. Okay. Let's move to Dubai. But then there are other assumptions might not hold. So you have no taxes. Second, let's assume that managers run companies with the stockholders' best interests at heart. So if you see a good project, you'll take it, a bad project, you will not. Let's assume that no firm in this world ever goes bankrupt. I told you it was completely unrealistic. Let's also assume that equity investors are honest. When you go to borrow money, you tell people exactly what you're going to borrow money on and you stay with that promise. And finally, let's assume that every company knows its future financing needs with certainty. You ready? Let's take this world and let's look at the trade-offs. Let's go item by item. What are the tax benefits of debt in this world? Zero. What about added discipline?
Zero.
Managers already do the right thing. Why do you need debt to discipline them? What about bankruptcy costs? Zero. Agency costs? Nobody lies. Zero. Flexibility costs? If you know your future needs with certainty, who needs flexibility? Zero, zero, zero. So debt has no benefits. Debt has no costs. So in this world, how much can you borrow? You can borrow nothing, you can borrow a lot. It doesn't matter. You've just derived corporate finance's most famous theorem. It's called the Miller-Modigliani theorem. Remember at the start of class 2 days ago, I said corporate finance is 58 years old. This is the paper that gave birth to it. In a world with no taxes, no bankruptcy costs, no default, and no agency costs, it does not matter how much you borrow. It's absurd, right? But with those assumptions, it doesn't matter how much you borrow. And it's perhaps one of the great tragedies of corporate finance is there are generations of MBAs we've sent out. And if you ask them, what's the only thing you remember about that capital structure class? You know what they say? The Miller-Modigliani theorem. And how convenient. I don't remember any of the other stuff, but it doesn't matter anyway. Bankers use the Miller-Modigliani theorem like garlic with a vampire. Every time you want to talk about that, the Miller-Modigliani, 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 back away. And to show you how absurd this hold that Miller-Modigliani has on people is, one of my very first classes that I taught, 1986, one of the students went on to become part of an LBO firm. And they actually were involved in the leveraged buyout of Bloomingdale's. It was a federated. And the deal was actually structured for a guy called Robert Campbell, Canadian who was certifiably crazy. He just, really, he had mental problems. But he was a deal maker. Crazy deal maker. They did the deal. And of course, if you do a deal on an upscale department store, you're kind of asking for trouble, right? The cycles come and go, so the cycle goes against them. Bloomingdale's, the federated goes bankrupt. The LBO firm involved loses all its money. This guy loses his job. 4 years later, I run into him on Wall Street somewhere, working somewhere else. He said, what are you doing? And he tells me he worked at this LBO outfit and they did a federated deal. And I said, you know what, I've never understood why you picked Bloomingdale's as your target for that deal, because it's not the kind of company I'd have picked. It's not a grocery store. It's a big department store. Why did you borrow so much money? And he said, don't you remember Miller-Modigliani? I said, I do. And I'm glad you live in a world with no taxes, no default risk, and no agency costs. And remind me again what happened to the firm you used to work for without a trace of irony. He said, it went bankrupt. You see the irony here? You're talking about Miller-Modigliani, which assumes, what about bankruptcy? Nobody goes bankrupt. In the same breath, you say it just went bankrupt. So let's get this off the table. In a world with taxes, with default risk, and with agency costs, can you borrow too much money? Of course, you can go bankrupt. In a world without taxes, you can do whatever you want. But if you find that world, let me know. Right? I haven't found it yet. So here are the two approaches we're going to use to try to come up with a mix of debt and equity. We're going to it's a trade-off. And as we go through this trade-off, you're going to see all these different qualitative factors come in. The first thing I'm going to do is use something we've already used in another context, which is the cost of capital. We use the cost of capital as a hurdle rate in investment analysis, right? So I came up with a cost of capital of 7.81% for Disney. Do you remember what the mix of debt and equity Disney had was? 88.4% equity, 11.6% debt. At that debt ratio, the cost of capital is 7.81%. But is that the right debt ratio for them? No, not right. Maybe if I tried 80-20, 70-30, 60-40, maybe there's a different mix of debt and equity at which I would have a lower cost of capital. You see, what does that get for me? If you have a lower cost of capital, you can take more projects, and your existing projects are all funded at a lower cost. They all get more valuable. So the cost of capital approach, you focus on the mix of debt and equity that minimizes your cost of capital. But I'm also going to make a confession after I go through that approach. That's not the way most companies decide how much to borrow. You know how most companies decide how much to borrow? It's actually, I wish it were that. At least that I can live with. They look at everybody else around them. They see what they're doing. And they try to stay as close as they can to an industry. So if nobody in the industry is borrowing, you don't borrow money. If everybody's borrowing a lot. So I'm going to talk about the pull that this has of looking at
real estate fit like this.
Exactly. Have you ever heard of an unlevered real estate developer? The guy who never borrows money? Doesn't happen. All cash, unless he's a cocaine dealer. Right? You're probably going to say, well, what's wrong with you? Right? So let's talk about the cost of capital approach. Yes, Anthony? Oh, you're in real estate, right?
Yes. And I'm not a cocaine dealer.
Okay.
But I
and
know
you don't
many,
pay in cash.
but,
and you borrow money. So you're doing all the things that real estate people should do.
I just wanted to know your thoughts about the rationale behind taking on that kind of leverage in terms of liability. A lot of times the thought process is we should take as much as possible out of the asset because in case of some occurrence, some kind of
drop in housing
slips
values
and falls, and they try to
right.
take. They sue you. They take you to court. They may try to. Well, what they can do is actually
take your asset away.
Take the asset away from you. So you try to pull as much value out of the property as possible. So how does that tie in?
It depends. There are a couple of ways the real estate game can be played. One is as a cash flow game, which is you buy rental property, you try to extract the cash flows over the life of the property, and you hope and pray that before that day of reckoning comes, you've taken enough cash out that even if they take the property away from you, you're okay. But you know that you don't. I mean, I work with this group called Edison Properties, which owns all the Edison the parking lots in the city. So it's a huge real estate company. And it's a family-run company. They don't want that to happen. They don't want that to happen because they view themselves as a going concern. And the problem with going that route of, because when they sue you, it's because you did not make an interest payment, so you did not come through on a debt payment. So they don't want that. If it happens, they can live with it, but they want to run their business to make sure that that is the exception rather than the rule. So when you borrow money, you want to borrow money based on your cash flows, not on the value of the property. And that's, I think, the starting point, right? Because a lot of real estate developers in the other game play the pricing game. They borrow based on the price of the property. They don't care about cash flows. What they hope to do is sell the property to somebody else at a higher price, cash out the difference, and then play this game over and over. So the world of real estate is actually divided into, are you a cash flow real estate investor, or are you a pricing real estate investor? All over Asia, it's the pricing guys who won out. So in India, for instance, people who buy real estate get no cash flows, but as long as they can flip it to somebody else at 100% more, who cares, right?
It's the difference between a venture investor or a core asset.
Exactly. So it's a philosophically, the world of real estate has both groups coexisting, and in any particular period, one group is going to be winning. So when housing prices are going like this, the pricing guys are going to look like heroes, and the cash flow guys are going to look boring. And why do you keep doing this? Parking properties over and over again. But you've got to decide up front what the driving force is. And if you're a cash flow driven real estate developer, my suggestion is keep the interest payments well below those cash flows, because you don't want to hit that tipping point where you can't make your payments. Because that's an admission your business is, in a sense, being truncated. So the way you borrow money has to come from within that. Because a banker might say, hey, your property was worth 15 million, I'll lend you 12 million, and you say, look, I'll settle for 7 because that's what I can comfortably service with the cash flows I generate on this property.
Okay, and that's the measure that you use.
Right.
The idea would be you want to maximize your leverage against
Subject to
your cash flow.
risk constraint. Right? So you always bring in the risk. If I just say I want to maximize returns to my equity investment, I know where I'm going to end up, 99% debt. Because it's pure returns. It goes back to the point that was raised earlier. Because I'm using leverage. Right? But if I say maximize return subject to risk constraint, it changes the game. Where I say I might stop at 70 or 80 or 85%, even though people are willing to lend me money. And that's what makes it so difficult, is there are people lined up ready to lend you money, and they're saying, no, I'm done. 20% is what I'm going to make as my equity, because that's what I feel comfortable doing. Question?
No, but two comments. One is the rental is the one that determines the amount of the loan, rather than valuation-wise.
That depends on the part of the world you're in. You'd be amazed at how often I've seen bankers lend on price, not cash flows. They shouldn't do that, but they lend based on price.
They do a combination. They do the valuation of the building, which is very subjective. Another one was the rent. That's the way
Right. But let me ask you a question. There are lots of real estate properties that are not rental income properties. They're not income properties. And people lend money on those. And there it's pure pricing, right? When I borrow money on a house, it's a pure pricing loan. They look at my income to make sure I cover the mortgage payment, but it's really the price that's the first factor. So while both come into play, it depends on which the dominant variable is. If you're a sensible lender, you should lend based on cash flows. If you're a sensible real estate developer, you should borrow based on cash flows. But there are a lot of people who are not I mean, if you look at The Big Short, in a sense, this is the core of the problem, right? People were lending money on properties because everybody else was lending money, and then you have a collection of properties. And their rationale was, I'm going to flip it to somebody else anyway.
But they thought they were lending on properties.
No, they thought they could flip it as a package to somebody else. So they said, it's like, have you ever played...
Then it became synthetic.
Right. And I'm saying that's part of the problem. Is it's out of your lap, so it's not your problem anymore, right? So let's talk about why the cost of capital matters. We haven't done any valuation. Actually, we have. When I did the Disney theme park capital budgeting, that's a valuation. It's a mini valuation. If you ask me to value Disney as a company, here's how I'd value it. I'd take the cash flows that Disney generates, just like I did for the theme park, for the whole company, and I'd discount those cash flows back at the cost of capital, and what I get as the present value is the value of the entire company. So keep that equation in mind. Let's assume I can hold the cash flows fixed, and that I lower my discount rate. What's going to happen to my present value? Same cash flows, lower discount rate, value goes up. And if at the limit I minimize my cost of capital, minimize my discount rate, what have I done to my value? I've maximized it. You think, so what? Remember the objective in corporate finance when we started the class 2 days ago? Maximize the value of the business. If that is in fact my objective, the right mix of debt and equity for me is the one that minimizes my cost of capital. So we've known this. For 50 years, corporate finance books have recycled this. And for much of this period, we've dealt with examples that you really can't make into practical ones. I'll show you a table I was shown in my first corporate finance class. During the class on the capital structure. So Professor walks in and says, today we're going to talk about the right mix of debt and equity for XYZ widget company. Why you want to invent a widget company when you have 41,889 real companies, I don't know. And he said, this is the table, this is the schedule of cost of capital, and he gave us really good stories for each part of the schedule, but none of us were satisfied at the end of the class, and you're going to see why. He said, as you borrow money, go from 0 to 90%, as you borrow more money, your cost of equity will go up. Why? Because equity gets riskier. This story made sense. He said, okay. And I remember a guy in the front row, wasn't me, putting up his hand saying, why is it going up the way it is? See, it goes up a half, then 0.6, then It looks basically like he made up the numbers. He said, don't worry about those details. Let's move on. We moved on. He said, as you borrow more money, your cost of debt will go up, which again makes sense, right? As you borrow more money, the banker gets more scared. And again, somebody put up, the same guy, I think, in the front row, was a pain in the neck to the entire class, put up his hand and said, why is it going up the way it is? And he said, don't worry about this. Let's move on. Then he said, the cost of capital is a weighted average of the cost of equity and the cost of debt, and that's the fourth column. And initially, as you borrow money, what happens? The cost of capital decreases. And then at some point, so does everybody see what the optimal debt ratio is? And he said the optimal debt ratio is 40% debt. If you were given the schedule for the entire cost of capital for your company and every debt ratio, could you tell me what the optimal is? A 10-year-old could, right? All you have to do is find the lowest number in that second to last column. It would be trivial. But let me ask you a question. How many points on this table do I have for Disney right now? 1. What's the 1 point I know? What's the existing cost of capital? The existing debt ratio. I don't have a schedule, I have a point. Do you see the challenge in doing this? Your job in cost of capital is to take that 1 point and flesh out the rest. And the way I've actually approached estimation was to allow me to be able to do that. So let's in fact look at, in fact this guy was so convinced we were dim-witted that he said, you don't get it, I'll show it to you as a graph. It's a low point in the graph. He missed the point. He said, our problem was not with what he was doing. We got it. The question we were asking in the real company, how would we get the cost of equity at all these hypothetical debt ratios, and how would we get the cost of debt at all of these different debt ratios? Okay. So remind me again how I got the cost of equity from Disney. It was only yesterday. Couldn't have forgotten already. I took their 5 businesses. I came up with a bottom-up unlevered beta for the businesses they were in. Then what did I do? I used that debt-to-equity ratio to come up with the levered beta. Do you see what I'm going to do at different debt-to-equity ratios? If you change your debt ratio, I'm going to come up with a new levered beta, that debt ratio. So that half the schedule is going to be relatively simple. How do you get the cost of debt for Disney? I looked up their rating for Moody's, and here I'm going to have a problem. Because I can call Moody's and say, can you tell me what the rating will be if I go to 20, 30, 40, 50? And they're going to say, do it, and then we'll tell you. In fact, I tried this. I said, can you, in fact, this was 20 years ago, I faxed the page to Moody's and said, can you just give me the rating of all these debt ratios? And I got the page back. It was an old student of mine. He said, we can't do that. But we did look at another way of getting the rating, right? If you did not have a Moody's rating, what do? We took the interest coverage ratio, and remember again what the interest coverage ratio is. Operating income divided by interest expense, and we looked through the lookup table and we came up with the rating, right? Do you see where I'm going to go next? So as your debt ratio goes up, what's going to happen to your interest expense? It's going to go up. As your interest expense goes up, your interest coverage ratio is going to go down. I'm going to go to that lookup table and say, hey, you just drop to a single A, triple B, a double B. I'm going to use the synthetic ratings process to estimate your rating at every debt ratio. So here's what I'm going to do. I'm going to get that 1 point nailed down before I get too ambitious. This is Disney's existing debt ratio. 88.6% equity, 88.4% equity, 11.6% debt. Existing cost of capital is 7.81%. So one way to frame what I'm doing is, can I get my cost of capital below 7.81% by changing the mix of debt? So the process as laid out includes the following. With the cost of equity, I'm going to go back to the unlevered beta. That's the advantage of not having the regression beta driving the process. And then I'm going to re-lever it at every debt ratio, get a cost of equity. With the debt, at every debt ratio, I'm going to compute the interest expense, the coverage ratio, the rating, come up with the cost of debt. Once I have those, I'm going to have a table that looks just like that XYZ widget company for Disney. But now you point any number in the table and say, why is the cost of equity that number at 50%? I should be able to give you an answer that goes past just a number. Let's move on. So you ready? Let's set the table. Let's start with the easy half of the equation first. We've done the mechanics, might as well do it. Remember yesterday we unlevered, so basically what I did was I took the unlevered beta based on the businesses they're in. That comes from the 5 businesses if you don't believe me. And at every debt ratio I computed the debt to equity ratio. Now how you get from a debt ratio to debt to equity? It's sheer math. If I say the debt ratio is 40%, I have 40% debt, 60% equity. You divide 40 by 60, you get 66.67%. So at every debt ratio I computed debt to equity. I use the debt to equity to come up with a levered beta. And no surprises. As I borrow more money, my levered beta climbs. As my levered beta climbs, the cost of equity goes. Half the table is done. To get the cost of debt is a little messier, and let me explain why. At every level, at every debt ratio, to figure out how much I will have in interest expenses, I need to know what dollar debt is involved. So the first thing I do is I take every debt ratio and I compute how much debt I would need to get to that debt ratio. So to get to a 50% debt ratio, I will need to borrow $69 billion. That's half the value of the company. So the first step is I get the debt. Then I multiply the debt by the interest rate I will have at that debt ratio to come up with an interest expense. There's a little flaw here at the end of the process. I'm going to come back and ask you whether you can spot it. So I start with the dollar debt. I multiply by the interest rate to come up with an interest expense. No surprise, it climbs as I borrow more money. As the interest expense climbs, what happens to my coverage ratio? It drops from infinity when I have no debt down to 0.61. My interest expense is actually higher than my operating income and I get to 90% debt. As my interest coverage ratio drops, my rating, remember that lookup table that I used? My rating which starts at AAA starts melting down. And once I have the rating, I can use the rating to get a default spread and an interest rate, which I multiply by the tax benefit to get my after-tax cost. Let me go through the sequence and you tell me where you see the problem. I start with the dollar debt. I multiply the dollar debt by an interest rate to come up with the interest expense. I divide the operating income, and I think you've already spotted it, but let me do the whole sequence. I divide the operating income by the interest expense to get a coverage ratio. I use the coverage ratio to get a rating. I use the rating to get an interest rate. What's the problem? I need the interest rate to get the interest expense. I need the this is like a chicken and the egg problem, right? But luckily, I don't think the chicken and the egg problem is a known solution, but this one does. I'm going to give you, there's an Excel spreadsheet that you find off the main web page for this class that does this whole thing mechanically for you. And when you open the spreadsheet, for some of you, you will get a warning from Excel saying there is circular references. I mean, Excel will start growing crazy, drawing lines. Don't freak out. That's a feature, not a bug. Because here's what I do. I start off with the interest rate from the previous level of debt because that's all I know. To come up with the interest expense, I come up with the coverage ratio, I come up with the rating, I come up with an interest rate, I feed it back in again. How many times? The Excel spreadsheet I set up does it 1,000 times, which is overkill because when I do it manually, that's never taken me more than 3 times. So it just spins back and forth. And what you're seeing is the final, so these are the final iterated interest rates at every level of debt as you go from 0 to 90%.
So how much do you see this happening in reality? Because sometimes people take debt and still their interest rate doesn't go up.
Find me that banker, I'll come borrow from him. Because if you find a sucker who keeps lending you money at the old rate, as your debt ratio goes from 10 to 10, my advice is take him to the cleaners. Right? So if you find, because that doesn't, you can see why. Put yourself in the shoes of a lender. If a person's doubling their debt and you keep lending money at the same rate, you are digging a hole for yourself. But if you can find, so I'm not saying those people don't exist, but if they do exist, and we're talking about big changes in debt. So you're not talking about adding $100 to $10,000 in debt. We're talking about adding $10,000 to the, because we're doubling. We're going from 10 to 20, 20 to 30. It'd be very, very strange if a banker said, your interest rate is stuck at whatever it was at the old level. Okay? So what I'm trying to do here is, if I want to make sure you're borrowing money for the right reasons. Then you're not borrowing money to take advantage of a banker. So think of this as a realistic assessment of what your cost of debt is going to be. And it climbs as your debt ratio goes up. But there's one little additional component here that's a little puzzling. Notice my tax rate is 36.1. It's 36.1 all the way up to 60%. And then it starts dropping. That's good, right? Lower taxes? But in this context, what happens? I'm actually reducing the tax benefit from debt. So what do you think is happening after 60% that's reducing my interest tax benefit? Remember, to get the interest tax benefit, what has to be true? I have to have income to cover the interest expense. And you know what happens at 70%? At 70, 80, and 90, my interest expense actually climbs above my operating income. And I say, sorry guys, you've run out of income. And it's actually a cautionary note that I see LBOs sometimes forgetting. You see these LBO guys putting a 1 minus T when they get a 90% debt. And they say, are you sure you will have enough income to cover the interest expense? You say, what are you talking about? It's 1 minus T. It is 1 minus T, but the government doesn't mail you a check for 40% of your interest expenses. Make sure you have the income to cover it. So basically I'm capturing that, which effectively means that there's a second layer impact on my cost of debt. Because my tax benefits are going away, my after-tax cost of debt climbs. Yes, John?
Can I just ask, from a high level, when we look back, I get that your beta is going to pick up the average of your earnings volatility when you look back in time. But how would you account for the cycle and the low point of the cycle and how your...
You know where it'll show up? What do I use as my numerator for my interest coverage ratio? My operating income, right? So if I'm a cautious borrower, I'm a commodity company, what should I be using as my operating income when I compute my interest coverage ratio? Not the last year's operating income. So if I'm Glencore, rather than using 2012 numbers, I should be using the operating income I had over a cycle. And what that'll do is it'll make your operating income lower during boom years. It'll mean you'll be, people looking at you say, well, how come you're borrowing so little? And your answer is going to be, I can't borrow on peak income, I've got to borrow on income that I think I can sustain. You'd still be hit by shocks, which is you might have thought a normal oil price as an oil company in 2013 was a $60 oil price. You never saw 27 coming. In which case you borrow on the 60, you're still going to be hurt by macro movements against you. But that in a sense is all you can do is bring in your expectations to your operating income. What that'll also do is it'll push you into lower ratings much more quickly and keep you from getting to high debt ratios during booms. It will also cut the other way, which is if you're at a low point in a cycle, and if you use the current operating income, it'll look like you can't borrow money ever again. And it might mean that you say, okay, I can look past the darkness and still go out and borrow money. So it'll take care of the problem, because it'll have all these ripple effects that'll push through and make you borrow a lot less because you're a cyclical or a commodity company. So now I have a table that looks like XYZ widget company. This is Disney's table. Debt ratio in the first column, beta in the second column, the levered beta. Cost of equity goes up as my debt ratio goes up. You ask me why, I'm going to go through the beta process. Cost of debt goes up after taxes. Why? Because my rating declines and my tax rate starts to fall off up to 70%. There's my cost of capital. So based on the cost of capital, what's the optimal mix of debt and equity for Disney? 40%. And it's a little unfortunate that we had two 40% in a row. I was actually doing this for a group of bankers about 5 months ago. I won't name the bank. And this was for a re-education program, which is for bankers, seasoned bankers. Being kind, these are bankers who've forgotten some basics. So they were forced to get into the room, so that many of them didn't want to be there. And I had to talk to them for half a day about capital structure. So one guy really did not want to be here. And he was going to make it clear to me he didn't want to be. He sat in the last row. He opened up the Wall Street Journal very ostentatiously, and he kept it open through the entire session. My only point was he didn't seem to ever turn the page. I almost stopped and said, can you at least turn the page to make it look like you're reading? No. So I finished this and he puts up his hand. I'm surprised, he's going to ask me a question. Here was his question. He said, can we safely assume that the optimal debt ratio for all companies is 40%? You're constantly looking for rules of thumb you can extrapolate, I guess. So let me tell you right up front, you cannot safely assume that the optimal debt ratio for all companies is 40%. In fact, are the 83 companies or 70-something companies in this class that you have, you're going to be plugging your numbers into that capital structure spreadsheet. And I've done some pre-testing of your numbers. And there are at least 3 companies in this class where the optimal debt ratio is 0%. Not because they lose money, but because even getting to a 10% debt ratio is going to flip them very quickly in terms of the cost of debt. And there's at least one company in this class where the optimal debt ratio, I think, is 80%. We'll talk about what causes optimals to vary across companies, but start thinking about what is it that causes some companies. There is no one rule of thumb that's going to work. So the cost of capital basically pushes you to find that mix that minimizes your cost of capital. So here's where we are with Disney. They have right now about $16 billion in debt. If you believe my analysis, the optimal is 40%. And at 40%, the debt that they should have is $55 billion. So what am I telling them? You have $39 billion in excess debt capacity. In fact, I'm going to go further. This analysis, and I did not mention this, when you borrow money in this analysis, you know where the money goes? It doesn't go into projects. It doesn't go into theme parks. It goes to reduce your equity. It's called a recapitalization. And the reason you do this is the minute you allow people to take projects with it, then you open up a second front, right? So we'll come back and talk about what if I cannot do that? What if I can't buy back stock? What if I can't pay dividends? What if I want to take projects? But the initial analysis is really, and all capital structure analyses do this. They keep the asset side fixed and change the mix of debt and equity. That's the recapitalization. But as I promise, I'll come back and say, what if they don't want to do this? What if that Shanghai theme park is going to cost a lot of money? Why can't they use the debt? We'll talk about whether you can extrapolate it if you don't want to reduce your equity.
How do you take the cash into account?
The cash, in a sense, there are two ways. One is you can work with net debt ratios all the way through. So you can do an optimal net debt ratio, in which case your interest coverage ratio will be a net interest expense coverage. It will be interest expense minus interest income. It's kind of crazy when you have 30 billion in cash and 50 billion in debt, because when you talk about borrowing money, you already have 30 billion in cash. It's kind of silly to go out and borrow money. So that's why I tried to strip it down to just debt and do the debt analysis and then say, hey, what the heck are you going to do with all your cash? In the case of Disney, not only do you have excess debt capacity, but you have 4 billion in cash. So it brings in that additional layer after I've done the optimal, because it means it's one more thing I've got to deal with in terms of getting to my optimal. So here's what I'm suggesting. They go out and borrow 39 billion. But that's a huge decision to make, right? And in fact, if there's any kind of sense left in the company, they have to ask me 3 questions. The first question they should ask me is, why should we do it? The answer seems obvious, right? Why am I asking them to do it? Because their cost of capital will drop. I'll show you exactly how much it will drop. It's 7.81% right now. If they borrow $39 billion and buy back all the stock, it's going to drop to? You can already see why this is not going to be a great pitch, right? Because what am I telling them? You borrow 39 billion, you buy back stock, your cost of capital is going to drop by 0.65%. And you know what their response is going to be? You want me to do what? To get what? It just seems like an incredibly big action to take for this very small impact. So that's the first thing we have to deal with, that make that real money. Yes. In fact, Julia, I'm going to make you very happy. I'm going to call her Julia. How about that?
His question.
Yeah.
You would first do just the
gross
revenue
debt.
rate, and then how do you account for the cash?
So basically, once I get the optimal, then I'm going to also look at your cash, because that's a second issue that I now have to deal with. Because now I say, not only do you need to borrow and buy back stock, you now have this cash still left over. What are you going to do with it, right?
So the second part of your
will be the cash part, which is, do you have
qualitative part?
Not even qualitative, it will be quantitative. I'll come back and ask, do you really need 4 billion in cash? And I'll make you justify whether you need the 4 billion because you feel it's a buffer. Yeah. Because otherwise you can think of cash as a continuum on being conservative, right? You can be conservative, borrow less and less and less money. You can get to 0. And you can keep being conservative by continuing to accumulate cash. So it's almost like a negative debt ratio. You've gone into the negative because you're... So this is, in a sense, if you think of it as a continuum, their optimal is 40, and if they had no debt, their actual debt ratio is minus 5%.
Right.
Okay?
Then what would be the optimal for this, in this case?
It'll still be the 40. The 40 is actually the optimal no matter what.
Just return the cash as dividend. And
That's, I think, what's going to be up for discussion, because they have... Returning all the cash might not be practical, because they might need something as a buffer in case. So what it does, it forces companies then to explain why they need 5, 10, 15, 20 or 200 billion in cash. And if they don't, then maybe we have to start thinking about the dividend policy part, which is the last component here. Okay.
Should
Yes?
the decision only be based on this, or there have to be all the perspectives?
Give me what other perspective there is. So business is a commercial enterprise.
0.6% against 39 billion. It just
Okay.
sounds risky.
So that's going to be my first job, is to convert the 0.65% to real money. What if I told you 0.65% is $20 billion in value? That's right. That's how much it translates to for Disney. You say 0.65% does that to me? Because it's a big company with a lot of cash flows. A 0.6 cost of capital don't move much for companies. So if you look at the magnitude, you say what's a 0.5% or what's a 0.6%? It's a big move from a valuation. But it's my job to make that 0.65% real money. You know, the second question is going to be, when you borrow a lot of money, what's always the question that creates the most worry? What if something goes wrong? And you know what the one answer I should never give is? Nothing will go wrong. Because it's almost like you're tempting the gods, and before you walk out of the room, something's going to hit you on the head. So I'm going to come back and deal with this as honestly as I can. Let's look at what can go wrong. Let's see if this optimal is robust enough to withstand a recession, withstand a scandal. And the third question you should ask me, and this goes back to the question of this buyback. What if I don't want to buy back stock? So I'm going to come back after the break and we're going to go through 3 questions. So let's see if we can get back by 11 or 11:01 because I'd like to keep going with a 15-minute break. Just on.